Hi, welcome back. In this, my 10th update on the COVID crisis, I'd like to do what I've done on previous updates first. I'd like to update what I see across markets around the world. I'd also like to look at how equities have played out, slicing the data by region, by sector, by industry. And then I'd like to take a look at something new that I've learned from this crisis. After all, a crisis is a time when you update what you already know or change some of the ways you think about markets. So let's start by listing out some of the basics of this crisis. In every crisis, you have a battle between fear and greed. This is not new in this crisis, it's always true. Sometimes fear wins out, sometimes greed wins out, which explains why markets are volatile and get pulled in different directions. Now, I don't have to tell you that this has been a period of incredible uncertainty. Uncertainty about where we're going or where we are right now. And there's a lot of divergence in what people think will happen, not just over the next few months, but over the next few years. It should therefore be no surprise that you see the market being pulled in both directions. A big up day followed by a big down day. A big up week followed by a big down week. A big up month followed by a big down month. What I'd like to do after I list out what this crisis has done so far is use a structure that I've used in both my corporate finance and valuation classes, which is the structure of a corporate life cycle, to see how this crisis has played out for young companies versus older companies, growth companies versus mature companies. So let's start by looking at how the markets have played out, not just in the last 2 weeks, but in the 12 to 14 weeks since this crisis started. My clock, as I said, for this crisis has been from February 14th of 2020. That's the date that US and European markets at least woke up to the fact that we had a crisis on our hands. So if you look at this table, I've looked at equity indices around the world. It's not a comprehensive listing. And I've looked at how each of these indices has done since February 14th. I've broken down the returns on each of these indices into two subperiods. February 14th through March 20th and March 20th through June 12th. The reason I've done that is very simple. This is a market that has played out in two acts. Between February 14th and March 20th, it was almost entirely a negative market. Stock prices kept going down and down. In fact, you can see around the world that most indices were down 30, 35, even 40%. Since March 20th, though, we seem to have turned the corner in markets, for good reasons or bad, and you see that many of these markets have retraced at least some of their losses. Collectively, global equities are now down less than 10% since the start of this crisis, and there are some markets that have now gone back into positive territory, especially China. So equities had a really tough first 6 weeks of this crisis, and since then, they've recouped at least some of their losses. Now, as equity markets went into a fear frenzy early on in this crisis, you saw US Treasuries drop. In fact, much of the drop in Treasuries across maturities, the 3-month, the 5, the 2-year, the 10-year, the 30-year, happened in the first 3 or 4 weeks of this crisis. The reason I emphasize that is whenever we talk about interest rates, people very simply jump to the conclusion that it's all the Fed's doing. The Fed's first big announcement in this crisis happened on March 15th. Now, I'm not going to underplay the role the Fed has played in this crisis, but much of the drop in interest rates you saw, especially in the Treasury market, happened before the Fed spoke up. On March 15th, of course, they announced a 0.5% cut in the Fed funds rate, dropping it close to zero, and they also announced a $700 billion quantitative easing program. 8 days later, on March 23rd, they removed that cap. They said essentially that they would spend as much on quantitative easing as the market needed. And they also announced that they were going to play the role of a backstop in corporate bond markets and lending markets. But if you look at interest rates for the most part, much of the action in rates happened before the Fed actions. Now, when you look at the corporate bond market, you see, in fact, I think the bigger effect of Fed actions. From February 14th to March 20th, yields and spreads on corporate bonds are in the rise. In fact, if you look at the default spreads across ratings classes, AAA, AA, single A, triple B, all the way down to high yield bonds, every single ratings class you saw default spreads widen dramatically between February 14th and March 20th, doubling, even tripling for some ratings classes. March 20th, if you look at the rest of the curve, you see that the spreads, the default spreads, have started to drop off. They still remain above where they were on February 14th, but they're well below where they were on March 23rd. The Fed's actions in operating as a backstop in the corporate bond market seem to have an impact on the default spreads in these markets. Now, if you look at commodity prices, I've tracked two commodities through this crisis, oil and copper, both sensitive to the economy. And if you look at the entire time period, copper had a dramatic drop again between at a significant drop, not dramatic, between February 14th and March 20th, but it's retraced its way back to where it was before the crisis. Oil, though, is a different story. Both Brent crude and West Texas crude are still down more than 30%, notwithstanding the fact that they've recovered some of the losses since March 20th. March 20th, they were both down more than 50%. There's something else going on in the oil market that goes well beyond the fears of a slowing economy. But copper at least seems to have turned the corner. If you look at gold and Bitcoin, gold, of course, has been a crisis asset of long standing. Gold is up about 9%, which reflects its standing as a crisis asset. Bitcoin, I'm not going to say anything good or bad about it, has essentially behaved more like risky equity. That doesn't make it a bad investment to have, but if people have sold you on Bitcoin as an alternative asset class, clearly it's not behaved as an alternative asset class. It's behaved as an extension of equities through much of this crisis. With that setup, let me look at equities by region. For those of you not familiar with how I do this, I collect the market caps of every publicly traded company in the world, and then I aggregate them and break them down. I slice and dice them. First, I slice and dice them down by region. So there are more than 37,000 companies in my sample. Sliced and diced by region, you can see that there are 4 parts of the world where the drop in stock prices, market caps, has been more than 20% if you go all the way back to February 14. 3 other emerging markets. You have India, you have Latin America, and you have Africa. UK is the one developed market that has been damaged just like the emerging markets. The rest of the world, there's been residual damage, but that damage now is lower than it was in March 20th. The S&P 500, after being down more than 30% on March 20th, is now down about 10%. So clearly, stocks have climbed back in some parts of the world faster than others. File that away, because if you look by sector, you see differences across sectors. The sectors that are most damaged tend to be big infrastructure businesses, often with debt. The sectors with the lightest damage are healthcare, for obvious reasons, but also technology, where essentially you see capital-intensive sectors being punished, more capital-intensive sectors being punished a great deal more than less capital-intensive ones. Building on that theme, I look at the 10 worst hit and best hit industries. Among the 10 worst hit, you see a lot of big infrastructure businesses again. And it's not so much the infrastructure as the debt that goes with the infrastructure that seems to be handicapping these companies. And if you look at and of course, banks are among the worst affected sector. And you saw that in the sectors, and you look at the industries, partly because they live in the reflected pain of other companies defaulting. If you look at the best performing sectors, you see healthcare and technology overrepresented. And again, it goes back to the earlier theme. This crisis has been easy on companies that don't have a great deal of capital in the ground and don't have a lot of debt. Now, what I'd like to do now is take a structure that I've used in both my corporate finance and valuation thinking, and it's helped me a great deal. And it's a notion of a corporate life cycle. Corporate life cycle very simply resembles a human life cycle. A startup is like a baby. Then you got very young companies, and those are like toddlers. Then those toddlers become teenagers. And I've often described Tesla, when I bought it, in fact, last year, as my teenage phenom. And then you become a company at the peak of your life. And then you start to mature. You get middle-aged. And then after middle age comes decline and eventual death. I know it's a morbid way to describe companies, and that there are some companies that seem to break the roots, that find reincarnation. IBM in 1992, Apple in 1999, Microsoft in 2013. Those companies, of course, become the stuff of legend, the companies that Harvard case writers write about, but they still remain the exception to the rule. For the most part, companies that fight aging tend to spend more than they'll get back by trying to fight aging. So that's a corporate life cycle. And one of the interesting questions then becomes, why does it matter? When you look across the life cycle, young companies tend to be money losing, have small revenues, and huge reinvestment needs. They tend to have negative cash flows. In fact, these negative cash flows are often described as cash burn. And cash burn is not something you wring your hand over. It's a feature, not a bug at young companies. As companies mature and their revenues start to take form and their operating margins turn positive, their reinvestment needs to start to drop off because their growth is starting to scale down. Your cash flows turn positive. And as you approach peak maturity, your cash flows peak. And then as you go into decline and revenues start shrinking and margins start to drop, your cash flows get smaller again. You think, who cares? File that away because I'm going to use it as a vehicle to talk about how crises play out across the life cycle. Finally, one other way to kind of structure a life cycle is to look at a financial balance sheet. You've all seen accounting balance sheets, right? Assets and liabilities. So what's a financial balance sheet? A financial balance sheet is a market value balance sheet. It's not a book value balance sheet. It's not designed by accountants. It comes from the market. Put very simply, if you take a company, any company, you can break its value down into assets in place, investments it's already made, and growth assets. You see, what are growth assets? This is the value that I'm attaching to expectations I have about your future investments. Dangerous thing to do, you say. Well, of course it is. And when you invest in a growth company, a big chunk of your value comes from growth assets. And of course, you got to fund those investments, and they can come from either debt, which is borrowed money, bank loans, corporate bonds, or equity. It's a general balance sheet. But you can actually structure where companies in the life cycle by looking at what they will look like on this balance sheet. Young companies get all or the bulk of their value from growth assets. If I have a startup, I get no value from assets in place. Everything comes from growth assets. As I mature as a company, the proportion of my value that comes from assets in place will tend to rise. And as I approach full maturity, the bulk of my value will come from assets in place. And then when I go into decline, there are no growth assets. It's just assets in place shrinking over time. Young companies tend to fund their investments with equity, and the reason is simple. If the bulk of your value comes from investments you're going to make in the future, you can't borrow money because what are you going to make the interest payments with? As companies mature, they tend to borrow money. They don't have to, but they tend to borrow money. So young companies tend to have negative cash flows, get the bulk of the value from growth assets, and are funded predominantly with equity. Mature companies get a big chunk of their value from assets in place, use more debt, and these are the differences across the life cycle. Now let's talk about how a crisis plays out. When you have a crisis, it affects companies at every stage in the life cycle, but it affects them differently and for different reasons. For young companies, the effect of a crisis is an access to capital. In most crises, what happens is access to risky capital gets turned off. Why? Because investors get scared. Venture capitalists and public market investors get more wary about investing in young companies. And when access to capital gets turned off, young companies' survival gets put at risk. Because to survive, these companies need to raise capital. It's not even to grow, to survive. And in a crisis, if it's severe enough, these companies will not be able to raise capital. So what happens then? They either have to shut down or sell themselves to more deep-pocketed, more mature companies in their business for a fraction of their true value. For young growth companies, even those that have turned the corner in terms of profitability, when you have a crisis, your growth prospects get put at risk. Why? Because you will not be able to raise the capital that you will need to make to grow. So these young growth companies might be able to survive, but they have to bring down their growth ambitions, which brings down their value. For mature firms, the danger from a crisis is the effect it has on existing assets. To the extent that a crisis affects the real economy and consumers stop buying goods and services, mature firms feel the pain in their existing asset base. And they feel it more if they sell discretionary products, things that people don't have to buy, than if they sell staples. And finally, for declining firms, especially ones with debt, a crisis poses a capital access problem again. Because these companies need access to capital to keep going. And if you put a shock to their existing assets, which is what the economy delivers, and you add a crisis where you cannot raise capital, many of these declining firms become distressed or go into default. So in a normal crisis, access to capital and the real economy are the effects that play out. And most crises, here's what happens. The market starts to go into free fall before the economy starts to slow down. Think back to every crisis you've been in. In 2008, it was the market that went into tailspin fest. The economy followed. It took a while for the full effects to show up in the economy. Now, in that crisis, if you think about the last quarter of 2008, the companies that were most affected were young companies that were burning through cash, companies that needed access to capital. Now, let's see what this crisis has delivered in terms of companies across the life cycle. Now, if you ask me to categorize companies across the life cycle, a very simplistic measure, and it's simplistic, is to look at corporate age. You're saying, what does that measure? It measures the number of years a company's been around since it was founded. I took every publicly traded company in the world and broke them down by age, from youngest to oldest, by decile. So you look at the very top of this table, you've got the youngest companies, the bottom you've got the oldest companies. Take a look at the very last column. And take a look at the 5 deciles of the youngest companies versus the 5 deciles of the oldest companies. You don't need to do any detailed or advanced statistics. Young companies clearly have been hurt less than older companies. Surprise, right? Now you might say, well, that's because this is too simplistic a measure. And you have a point, right? Because in some sectors, companies age faster. A 20-year-old tech company might be like a 100-year-old manufacturing company. So here's the second cut I took. I took the expected revenue growth of these companies pre-crisis. So think of this as the purest measure of growth, because income growth can come from cutting costs, improving margins. Revenue growth has to come from companies growing their base. And I broke companies down by revenue growth, from lowest growth to highest growth. Take a look at the last column again. The lowest growth companies have been hurt a lot more during this crisis than the highest growth companies. You take every slice based on corporate life cycle, it looks like the companies in the earliest stages of the life cycle have been hurt less than more mature companies. Now you might wonder what's different about this crisis that's creating this phenomenon. I think every crisis brings differences, but this one is a unique one. Why? Because on the date that it started, February 14th of 2020, markets were actually very upbeat. In fact, risk-taking was at a peak, risk premiums were low, probably at historic lows, both in the bond and the equity market. Financial markets were doing well, and then we shut the entire global economy down. In other words, the economy got shut down first, and markets were left to fend for themselves. Now, early on, markets reacted as they should, right? They went down because people were afraid. But remember that shutdown came with a timer, which, whether you believe the timer or not, that in a few months the economy would start to open up again. That's not something you see in a crisis where you say, on June 30th, we're going to open up the global economy again. Now, you might say there was uncertainty about the date and what would happen. You're right. But that time frame makes this crisis different from prior ones. For whatever reason, this is a crisis where private risk capital has never quite fled the market like it does in most crises. For the first 3 or 4 weeks, private risk capital, whether it was in the private market in the form of VC or private equity money, or in the public market, or in the debt or equity market, the first few weeks you saw it freeze up, but in the middle of March, it started to come back, and it came back at a rate that most people did not predict. And that return of risk capital has benefited younger companies. It's made it more likely that they will survive. It's allowed them to go out and raise capital to get through. In fact, it's also benefited companies at the other end of the life cycle. Those declining companies, especially early in the crisis, where people worried about, will the airlines make it? Will Hertz make it? Those companies have been able to raise capital in a way that most people did not predict. Most pros, put that, did not predict early in this crisis. Now, this difference between young and old companies, I think, explains a great deal of what I've been also seeing in previous weeks in my presentations. Remember that in an earlier post I talked about how value stocks versus growth stocks have been doing, and in this crisis that growth stocks have outperformed value stocks. Well, if you think about old-time value investing is focused on mature companies with a lot of existing assets. Growth investing is focused on young companies where everything lies in the future. And based on what we've seen here, you can see why growth investing has done better than value investing. It might also explain why the amateurs have beaten the pros. The pros, I think, if by pros you mean hedge fund investors, older professional money managers, remembered past crises, and they tried to read from the same rule book. They remembered what happened in 2008 and 2000 and 1992 and 1981. And in this crisis, those memories actually pushed you in the wrong direction. Now, I just want to be quite clear that this crisis is not over, but the trajectory of markets in this crisis, I think, has followed the coronavirus itself, right? As you see, as infections pick up, as you see news about vaccines, you see markets moving. So perhaps it's no surprise that that the markets are behaving just like the virus. The virus, as you know, has had a much more deadly effect on the older parts of the population, and the market seems to be punishing older, more mature companies and younger companies. Now, I know the story is not completely told. Maybe there will be a freeze in risk capital as we continue through this crisis. But for the moment, at least, looking across companies, this crisis has thrown a lot of surprises at us. And I have a feeling that it's not quite done. Thank you very much for listening, and I hope you enjoyed this session.